There is a deadline hiding in the tax code right now, and if you turned 73 last year, it may be about to force you to pull money out of your retirement account twice in a single year. Not once, twice. And the second withdrawal could quietly push you into a higher tax bracket, raise the tax on your Social Security, and lift your Medicare premium for an entire year. By the time this video ends, you will know exactly who this hits, the precise dates that trigger it, and the number most people do not run until the tax bill has already arrived. This is not a rumor, and it is not a scare, and it is not a loophole you have to go looking for. It is the default outcome for a specific group of people who do the thing that feels most responsible. It comes straight out of the rules the Internal Revenue Service publishes on its own website, rules that were reshaped by a law Washington passed called Secure 2. The IRS confirms that once you reach a certain age, you must begin taking what are called required minimum distributions, forced withdrawals from your traditional retirement accounts, whether you need the money that year or not. Miss the deadline and there is a penalty. Take it at the wrong moment and there is a different kind of penalty, the kind that does not come with a warning letter, the kind that just shows up as a bigger tax bill. Here is the specific trap. According to the IRS, your very first required withdrawal has a later deadline than all the ones that follow. That sounds like a gift. For a lot of people in 2026, it is going to turn into the opposite. Because delaying that first withdrawal, the thing that feels like the smart, patient move, is exactly what can stack two withdrawals into the same calendar year and hand you a tax bill you did not see coming. Think about how strange this is for a moment. You spent 30 or 40 years being told to save, to defer, to leave the money alone and let it grow. That was the whole discipline of a working life. And now, at the exact moment you have finally stopped working, the government reverses the instruction. It stops asking you to save and starts ordering you to withdraw on its schedule in its amounts, whether you have any use for the money that year or not. The reason is not complicated. That traditional retirement money was never taxed on the way in. The government let it grow untouched for decades precisely because it always intended to tax it on the way out. Required minimum distributions are how it finally collects. The forced withdrawal is the government calling in a tax bill it has been patiently waiting on since you were in your 30s. Most people understand that part, at least in the background. What they do not understand is the timing, and timing is the entire game here. The same withdrawal, taken in one year instead of another, or bunched with a second withdrawal instead of spread out, can change your tax bill by thousands of dollars without changing a single thing about how much you actually saved or spent. That is the uncomfortable truth at the center of this. In retirement, when you take the money can matter as much as how much you take. I'm going to walk you through all of it. What actually changed in the law, the two dates that create the double withdrawal, who falls into it in 2026 specifically, the real numbers behind why two withdrawals in 1 year hurts so much more than two spread across 2 years, how it ripples into Social Security and Medicare, and what people who saw this coming are quietly doing about it before the year closes. Stay with me, because the difference between understanding this in July and understanding it in December could be thousands of dollars. To understand the trap, you have to understand what Washington changed, because the whole thing grew out of a law that was sold as good news for retirees. The law is called Secure 2. It moved the age at which you are forced to start withdrawing from your traditional retirement accounts. For decades that age was 70 and a half, then it became 72, and under Secure 2 it moved again. According to the IRS, if you were born between 1951 and 1959, you must begin taking required minimum distributions in the year you turned 73. If you were born in 1960 or later, that age moves all the way up to 75. Schneider Downs, a firm that tracks these rules, confirms the same breakdown. Anyone born before 1951 is already past this and unaffected. On the surface, that is a good change. Letting your money stay in the account longer means more time for it to grow, and more time before the tax collector gets a share. That was the pitch, and for many people it genuinely is a benefit. But every time Washington moves a deadline, it also moves the pileup that can form around that deadline. And this particular deadline has a second rule attached to it that most people never read. Here is that second rule, straight from the IRS. Your first required withdrawal does not have to be taken in the year you actually reach your required age. You are allowed to delay it until the 1st of April of the following year. Every withdrawal after that first one must be taken by the 31st of December of its own year. So the very first withdrawal gets a grace period that no other withdrawal gets. It is the only one you are allowed to push into the next calendar year. Now watch what that does. If you reach your required age and you decide to use that grace period, delaying your first withdrawal into the next year, you have not escaped anything. You have simply moved your first withdrawal into the same year as your second one, because the second withdrawal still has to come out by that year's December deadline. 2 required withdrawals, 1 calendar year, 1 combined tax bill. That is the mechanism, and it was built right into the law that was supposed to be doing you a favor. It helps to understand why the age kept moving in the first place. When Congress passed the original Secure Act and then Secure 2, the argument was that people are living longer and working longer, so the old starting age of 70 and a half no longer fit the way people actually retire. Pushing the age to 73, and eventually to 75, was meant to give savers more room. AARP and other groups that follow retirement policy generally welcome the higher age as a benefit for people who do not need to tap their accounts early. And for millions of people, that is exactly what it is. If you can comfortably leave the money alone, more tax-deferred growth is a genuine advantage. But notice what a higher starting age also does. It compresses more of your forced withdrawals into fewer years of life. The later you are made to start, the larger each required withdrawal tends to be as a share of the account, because the IRS life expectancy factor shrinks as you age. So the same policy that feels generous on the front end can mean bigger mandatory withdrawals once they finally begin. It is not a trick, and it is not a scandal. It is simply the arithmetic of deferring a bill rather than erasing it. The bill always comes. The only questions are when and in how large a chunk. That is the frame to keep in mind as we go. Every one of these rules is a rule about timing, not about whether you owe the tax. You will pay income tax on that traditional retirement money one way or another. What Secure 2 changed is the schedule, and it is inside that schedule, in the fine print of the very first deadline, that the double withdrawal problem lives. The change Washington made was real, and it was framed as relief. What almost nobody explained at the time was that the relief comes with a timing trap, and 2026 is the year that trap springs shut for a specific and very large group of people. Let me slow this down to the 2 dates, because everything depends on them, and the way they interact is the whole story. Say you turned 73 at some point in 2025. Under the rules the IRS lays out, that means 2025 was your first required distribution year. But you did not have to take that first withdrawal during 2025. The IRS gives you until the 1st of April 2026 to take your very first one. So you look at that, and it feels responsible to wait. Why pull the money and pay the tax in 2025 if the government is telling you that you have until April of next year? So you wait. Many people wait. Financial habit says do not pay a tax sooner than you have to. Here is what waiting does. Your first withdrawal, the one for 2025, now lands in the spring of 2026. But 2026 is also a required year of its own, which means you owe a second withdrawal, the one for 2026, and that one must come out by the 31st of December 2026. Schneider Downs describes this exact situation plainly. If you delay your initial withdrawal until the 1st of April, you must take 2 required withdrawals in that same calendar year, the first by April and the second by the end of December. So both withdrawals land in 2026, the one you delayed and the one that was always due. 2 full required distributions, taxed as ordinary income, stacked into a single tax year. And because retirement account withdrawals count as income the moment they leave the account, the government does not see 2 separate reasonable withdrawals. It sees one unusually large lump of income in 1 year. This is the part that catches people. They think of the grace period as a break, And for cash flow, in the moment it can feel like one. But taxes are not calculated on cash flow. They are calculated by the year. And stacking 2 years of forced withdrawals into 1 year is one of the fastest ways to inflate a single year's income, which is exactly the thing that pushes you up the tax ladder. Let me name the psychology, because it is the reason this trap works so well. There is a deeply trained instinct in anyone who has managed money carefully, and that instinct says never pay a tax before you are legally required to. Defer, defer, defer. That instinct served you well for your entire working life. It is the reason the retirement account grew in the first place. So when the IRS offers a grace period that lets you push the first withdrawal into next year, that instinct fires automatically. Delay it. Keep the money working. Do not hand the government its cut a day early. The trap is built precisely on top of a good habit. It uses your own financial discipline against you, because the one-time deferral does not help is the time it stacks 2 taxable events into a single year. There is a second, quieter mechanism too, and it is worth saying out loud. The rules around this first withdrawal are genuinely confusing, and confusion produces delay by default. Someone turns 73, retires, has a lot on their mind, and simply does not register that a hard deadline has started ticking. They are not making a sophisticated tax decision. They are just busy living their life. By the time they or their tax preparer notice, the calendar has already carried the first withdrawal into the next year, right on top of the second. The delay was never chosen. It happened by inattention, which for a rule this obscure is the most natural thing in the world. There is a version of this that is even more common than people realize. It is not only the folks who consciously chose to delay. Some people simply did not know the first withdrawal was required, missed it in 2025, and now must take it by April 2026 to avoid a penalty, which drops them into the exact same double withdrawal year without ever having made a decision at all. Either way, the calendar does the same thing. 2 withdrawals, 1 year, 1 bracket climbing bill. So who exactly is walking into this in 2026? Let me draw the circle as tightly as I can, because this does not hit everyone, and the people it hits often do not realize they are the ones. The core group is anyone who turned 73 during 2025 and chose to delay their first required withdrawal into 2026 using that April grace period. If that is you, or a parent, or anyone you know who just crossed into their early 70s with money in a traditional retirement account, this is the year the 2 withdrawals collide. Under the birth year rules the IRS publishes. Turning 73 in 2025 means you were born in 1952, which falls squarely inside that 1951 to 1959 window where 73 is the required age. Now, one important piece of good news, because this trap has real limits. It only touches certain kinds of accounts. According to the IRS, required withdrawals apply to traditional retirement accounts, the traditional IRA, the SEP and simple IRAs, and workplace plans like the traditional 401k. They do not apply the same way to Roth accounts. In fact, the IRS confirms that as of recent rule changes, Roth accounts inside an employer plan, such as a Roth 401k, no longer require withdrawals during the owner's lifetime at all, matching how Roth IRAs have always worked. So if your retirement savings are sitting in Roth accounts, this particular collision does not reach you. The trap is a traditional account problem. There is also the person who did not delay on purpose but simply missed the first withdrawal. Maybe they retired recently and did not know the clock had started. Maybe the paperwork sat unread. Whatever the reason, if the 2025 withdrawal never came out, the IRS deadline to fix it without a steeper problem runs into 2026, which again stacks it on top of the 2026 withdrawal. So the circle includes both the people who plan to wait and the people who never knew they had to act. There is also the situation of inherited accounts, which follows its own separate set of rules and catches a different group of people. If you inherited a retirement account from someone who had already reached their own required withdrawal age, current rules generally require you to keep taking annual withdrawals from that inherited account while also emptying it within 10 years. That is a distinct problem from the double year we are describing, but it lands on many of the same people, those in their 50s, 60s, and 70s, managing both their own accounts and one they inherited. If you are handling an inherited account on top of your own, you may have more than one withdrawal deadline running at the same time, and they do not coordinate with each other. Each one has to be tracked on its own. And here is the quiet reason this matters more in 2026 than it might in an ordinary year. A very large wave of Americans is passing through their early 70s right now. The group born in the early 1950s is sizable, and a meaningful share of them are hitting this 73 threshold in exactly this window. That means this is not a rare edge case affecting a handful of people. It is a timing issue that a whole cohort is walking into at once, most of them with no idea that the patient, sensible choice to delay is the very thing setting up the bill. It is worth pausing on why the Roth exception matters so much, because it points to a larger pattern. A Roth account was funded with money you already paid tax on. The government has already collected its share, so it has no reason to force you to withdraw. That is why, as the IRS confirms, Roth IRAs never required lifetime withdrawals, and why the newer rules extended that same freedom to Roth accounts inside workplace plans starting in recent years. The lesson buried in that contrast is simple. The forced withdrawal is not really about your age. It is about whether the government has been paid yet. Traditional accounts have not been taxed, so they are forced out on a schedule. Roth accounts have, so they are left alone. Two people the same age, with the same amount saved, can face completely different rules depending only on which type of account holds the money. There is one more group worth mentioning, because they often get overlooked. People who are still working past 73 and who have a traditional 401k at the employer they currently work for may be able to delay withdrawals from that specific workplace plan until they actually retire, under what is sometimes called the still working exception. It does not apply to IRAs, and it does not apply to old 401k accounts from former employers, but for the right person, it changes the timing picture entirely. It is another reminder that the details of your exact accounts and your exact situation decide everything here. If you are in that circle, the question is no longer whether the two withdrawals happen. If you delayed, they are happening in 2026. The only question left is what that does to your numbers, and that is where this gets real. Let me put numbers on this, because the abstract version does not land until you see it in dollars. A required withdrawal is calculated from two things: the balance in your account at the end of the previous year and a life expectancy factor the IRS publishes in a table. The older you are, the larger the fraction of your account you must withdraw. In the first few years of required withdrawals, for someone in their early 70s, the amount typically lands somewhere in the range of a few percent of the account balance. On a traditional retirement account worth several $100,000, that first withdrawal can easily be well over $10,000, and for larger accounts, considerably more. Here is a detail that makes the double year worse than it first appears. The two withdrawals landing in 2026 are not calculated from the same balance. The first one, the delayed 2025 withdrawal, is based on your account value at the end of 2024. The second one, the 2026 withdrawal, is based on your account value at the end of 2025. If the market did well and your account grew over that year, the second withdrawal is calculated off a larger balance, which means it is a larger dollar amount. So the two stacked withdrawals are often not equal. In a strong market year, the second can be bigger than the first, and both are landing in the same tax year on top of each other. The stack is not just two of the same thing. It can be two of a growing thing. And remember what these withdrawals are made of. They are ordinary income, taxed at your regular income tax rate, not the lower rate that applies to long-term capital gains. There is no special retiree discount on a required withdrawal. Every dollar comes out and joins your Social Security, your pension, your interest, and any other income, and the whole pile is taxed together on one return. That is why bunching hurts. You are not adding a small taxable amount to a small pile. You are adding a second full year's forced withdrawal to a pile that already includes everything else you receive in 2026. Now double it. In a normal year, you take one withdrawal, 1 year's worth of that income, and it sits on top of your Social Security and any other income you have. In the double year, you take two. If each withdrawal is, say, $18,000, the difference between spreading them across 2 years and stacking them into one is the difference between adding $18,000 to your income twice in 2 separate years versus adding $36,000 to your income all at once. That single detail is the whole problem, and here is why. The federal income tax is built in brackets. The first slice of your income is taxed at a low rate, the next slice at a higher rate, and so on up the ladder. When you keep your yearly income lower, more of it stays down in the low brackets. When you stack 2 years of withdrawals into one, you can shove that top slice up into a higher bracket, so the second withdrawal effectively gets taxed at a steeper rate than it would have if you had taken it in its own separate year. You did not earn more money over your lifetime. You simply bunched it, and the bunching itself cost you. Kiplinger, which tracks these rules closely, points exactly to this problem. Taking 2 required distributions in 1 year can bump you into a higher tax bracket, and it does not stop there. It also affects the taxation of your Social Security and your Medicare premiums, which we will get to in a moment. Let me make the bracket point even more concrete, because this is where the real money moves. Imagine your ordinary income in retirement, from Social Security and a pension and a normal single withdrawal, leaves you comfortably inside a middle tax bracket, with a little room before the next bracket up begins. In a normal single withdrawal year, you use up that room slowly and stay put. Now stack a second withdrawal on top. That extra chunk of income does not get taxed at your average rate. It gets taxed at your top rate, stacked on the very top of everything else, and if it crosses the line into the next bracket, the portion above the line is taxed higher still. This is what people mean when they say a distribution pushed them up a bracket. It is not that all your income suddenly costs more. It is that the last dollars, the bunched ones, get taxed at the steepest rate you face. And that is only the federal picture. Many states tax retirement withdrawals as income too, and a spike in your federal taxable income often flows straight through to a higher state tax bill in the same year. So the bunching can cost you at 2 levels of government at once, federal and state, both triggered by the same timing decision. Someone in a state with a meaningful income tax can watch a single stacked year cost noticeably more than the identical withdrawals would have cost spread across 2 calendar years. None of it changes what you saved. All of it comes down to which year the dollars landed in. Here is the re-engagement question worth pausing on. How many people, when they chose to delay that first withdrawal, actually ran the 2-year comparison? Almost none. The delay feels free because in the moment no tax is due. The cost is invisible until the following spring, when both withdrawals are sitting on the same tax return, and by then the year is closed and the choice cannot be undone. The number that mattered, the comparison between 1 big year and 2 smaller years, was available the whole time. It just was not run. Now here is where the double withdrawal stops being just a tax bracket story and starts reaching into parts of your finances you might not connect to it at all. Because in retirement, income does not just get taxed. Income triggers things. And 2 of the biggest things it triggers are how much of your Social Security is taxed and how much you pay for Medicare. Start with Social Security. A lot of people are surprised to learn that Social Security benefits can be taxed at all, but they can, and whether they are depends on your total income for the year. As your other income rises, a larger share of your Social Security benefit becomes taxable, up to a cap. So when you stack 2 required withdrawals into 1 year and your income jumps, you can drag more of your Social Security into taxable territory in that same year. It is a double hit. The withdrawals themselves are taxed, and they simultaneously make your Social Security more taxed than it would have been. Kiplinger names this directly as one of the ripple effects of bunching required withdrawals. Then there is Medicare, and this one has a name that catches people off guard. It is called IRMAA, the Income-Related Monthly Adjustment Amount. Here is how it works. Medicare looks at your income, and above certain thresholds, your monthly premiums for Medicare go up. The higher your income in a given year, the higher the surcharge, and there is a delay built in. Medicare generally looks back at your income from a couple of years earlier to set today's premium. So a spike in your income in 2026, caused by two stacked withdrawals, can raise your Medicare premiums not immediately but on a lag, hitting you in a later year when you may have completely forgotten what caused it. Sit with that sequence for a second, because it is the part almost nobody maps out. You delay a withdrawal to be prudent. That stacks two withdrawals into 2026. The stacked income pushes you up a tax bracket. The same income pulls more of your Social Security into the taxable column. And then, a year or two down the road, that same income spike quietly raises your Medicare premium through IRMAA. One timing decision, made to save on taxes, echoing through three separate parts of your finances across multiple years. Let me put the IRMAA piece in sharper focus, because the 2-year lag is the part that fools even careful people. Medicare does not look at your current income to set your current premium. It generally reaches back to your tax return from 2 years earlier. So the premium you pay in a given year is usually based on the income you reported 2 years before. That means a stacked withdrawal year in 2026 does not show up in your Medicare premium in 2026. It shows up later, on a delay, at a moment when you have long since stopped thinking about those two withdrawals. The bill arrives detached from its cause, which is exactly why so few people ever connect the two. They see their Medicare premium jump and have no idea it traces back to a timing decision they made 2 years earlier. An IRMAA does not ease you across gently. It works in tiers like steps. Cross a threshold by even a small amount, and you move up to the next surcharge tier for the whole year. So a stacked withdrawal that nudges your income just over one of those lines can raise your monthly premium by a meaningful amount for 12 months, even though the income that pushed you over was only a little past the edge. This is why the exact thresholds matter so much, and why people who plan around this pay attention to where those lines sit before they cross them. None of this means the withdrawals were avoidable. They are required. That is the whole point of the word required. What was avoidable for many people was the stacking. And the reason it happened is that the three effects live in 3 different places, on 3 different forms, arriving at 3 different times, so almost nobody sees them as one connected event until they are looking back at it. Now let me talk about the other side of this, because so far we have been talking about people who take their withdrawals but stack them badly. There is a worse outcome, and it is missing the withdrawal entirely. Washington built a penalty for that, and while Secure 2 softened it, it is still one of the steepest penalties in the entire tax code. Here is the rule as the IRS states it. If you fail to take your full required withdrawal by the deadline, the amount you failed to withdraw may be subject to an excise tax. Under Secure 2, that excise tax is 25% of the amount you should have taken out and did not. To put that in plain terms, if you were required to withdraw $20,000 and you took nothing, the penalty alone could be $5,000, and that is separate from the regular income tax you will still owe on the withdrawal once you finally take it. Now the same law did add a meaningful escape hatch, and this is worth knowing because it can save people who catch their mistake. According to the IRS, if you correct the missed withdrawal in a timely way, generally within a 2-year window, that penalty can drop from 25% down to 10%. 10% is still a serious penalty, but it is far better than 25, and the message from the rule is clear. If you realize you missed a required withdrawal, moving quickly to fix it is not just tidy, it directly cuts the penalty in half and then some. This is also the hidden risk sitting underneath the delay trap we have been discussing. Remember, the reason some people end up with 2 withdrawals in 2026 is that they delayed the first one to the April deadline. But that April deadline is not a suggestion. It is a hard line. Miss it, and the first withdrawal is not just late, it is exposed to that excise tax. So the grace period that creates the stacking problem is the very same grace period that, if you lose track of it, opens the door to the penalty. It giveth a delay and it taketh a penalty, and the only thing standing between the two is whether you know the exact date. Here is a concrete number to hold onto. The excise tax is calculated on the shortfall, the gap between what you were required to take and what you actually took. So even a partial withdrawal that comes up short can trigger it on the missing piece. This is why people who work with these rules stress getting the calculation right, not just remembering to withdraw something. Taking almost enough is not the same as taking enough, and the penalty lives in that gap. It is worth appreciating just how unusually harsh this penalty is by the standards of the rest of the tax code. Most tax penalties are calculated as a percentage of the tax you owe, and they tend to run in the single digits per year. This one is different. It is calculated on the withdrawal amount itself, not on the tax, and even after Secure 2 softened it, 25% is enormous. For most of its history before this law, the penalty was even steeper, at 50% of the shortfall, which is why financial advisors have long treated the required withdrawal deadline as one of the few truly unforgiving dates in retirement. Secure 2 cutting it to 25 and to 10 for a prompt fix was a genuine improvement. It is still not a penalty anyone wants to meet. The practical defense against it is almost boring, and that is the point. Know your required amount, calculated from last year's ending balance and the IRS factor for your age. Know your deadline, the 1st of April for a first withdrawal or the 31st of December for every one after. And confirm in writing that the full amount actually came out, not almost all of it. Many people set the withdrawal to happen automatically through their account provider precisely, so that a busy month or a distracted season never becomes a five-figure penalty. The people who get burned are rarely the ones who understood the rule and planned around it. They are the ones who never knew the clock was running. The takeaway is not fear. It is precision. This is a corner of the tax code where the exact dates and the exact amounts matter more than almost anywhere else, and where a small administrative slip carries a price tag measured in thousands. So if you are in the circle, or you love someone who is, what are people actually doing about this? I want to be careful here, because I am not going to tell you what you should do. I am going to tell you what options exist and what people who saw this coming are considering, and then point you to the one thing everyone in this situation should do. The first thing people look at is timing, and specifically not delaying that first withdrawal in the first place. For many people, taking the first required withdrawal in the year they turn 73, rather than pushing it into the following spring, keeps 1 year's withdrawal in 1 year and the next year's in the next, avoiding the stack entirely. Financial writers at outlets like Kiplinger point out that spreading the withdrawals across 2 separate tax years, rather than bunching them, is one of the most direct ways to keep any single year's income from spiking. For the people reading this before they have made the delay decision, this is the fork in the road. For people already looking at a double year, some are considering how to manage the rest of their income in that same year to keep the total from crossing key thresholds, the tax bracket lines, the Social Security taxation points, the Medicare IRMAA cutoffs. The idea is that if 2 withdrawals are unavoidable in 1 year, the surrounding income choices in that same year become more important than usual, because those are the pieces that are still movable. There is also a strategy specific to people who give to charity, and this one is directly relevant to the numbers we discussed. It is called a Qualified Charitable Distribution, or QCD. The rules let people at the required withdrawal age send money directly from their IRA to qualified charity, and that amount can count towards satisfying the required withdrawal without being added to their taxable income the way a normal withdrawal is. Kiplinger notes that the limit on these qualified charitable distributions for 2026 is $111,000. For someone who already gives to charity and is staring at a stacked withdrawal year, routing part of that required amount straight to charity is one way the withdrawal can be satisfied without inflating the income that triggers all those ripple effects. There is a longer game some people are playing too, and it is worth knowing exists even though it does not help inside a single stacked year. It is called Roth conversion, and the idea is to move money out of a traditional account and into a Roth account in the lower income years, often the years between retiring and the start of required withdrawals, paying the tax on that money at a time of your choosing rather than on the government's schedule. Every dollar converted to Roth is a dollar that will never be subject to a required withdrawal again, because, as we covered, Roth accounts are not forced out during the owner's lifetime. People who look ahead sometimes use those quieter early retirement years to shrink the traditional account on purpose, so the forced withdrawals later, including any stacked year, are smaller and less painful. It is a multi-year strategy, not a rescue for a year already underway. But it is one reason the people who plan early tend to face gentler required withdrawals later. For those already inside the double year, the most common thread among people who handle it well is simply that they looked early. They did not wait for the tax return to reveal the damage. They ran the two withdrawal numbers in the summer, saw where their income was heading, and made whatever adjustments were still available while the year was open. Almost nothing can be fixed in April once the year has closed. Quite a lot can be shaped in July while it is still running. But here is the honest center of all of it. Every one of these options depends on your specific numbers, your account balances, your other income, your state, your charitable intentions, and the exact dates on your own calendar. This is precisely the kind of situation where a qualified tax professional or financial advisor earns their fee many times over, because the cost of running the calculation wrong, as we have seen, is measured in thousands of dollars across multiple years. The people who handle this well are not the ones who found a clever trick. They are the ones who ran the actual numbers on their actual accounts before the year closed. So what should you be watching from here? Let me pull the whole picture together into the things worth keeping your eye on, and then close with the one line I want you to remember. First, watch the calendar if you turn 73 in 2025. The date that matters most is the 1st of April 2026. That is the last day to take your delayed first required withdrawal without exposing it to that excise tax, and taking it means accepting that your second withdrawal, due by the 31st of December 2026, lands in the same year. Know which of those two situations you are in before the deadline, not after. Second, watch your total income for the year 2026 if you are in the double withdrawal group, because two stacked withdrawals do not just raise your income tax. As we covered, they can pull more of your Social Security into the taxable column and, on a lag, lift your Medicare premium through IRMAA. The income number for this 1 year is doing more work than usual, and it is worth knowing where the key thresholds sit before you cross them by accident. Third, watch the birth year rules going forward, because they are staggered. 73 is the required age for people born between 1951 and 1959, but for anyone born in 1960 or later, the required age moves up to 75 under Secure 2. That means the exact year this clock starts is different depending on when you were born, and the delay trap we described attaches to whichever year is your first required year. If you are younger than this year's group, your version of this deadline is coming, just later. And fourth, watch for the softer penalty rule if you or someone you know ever misses a required withdrawal. The excise tax is 25% of the shortfall, but correcting it promptly, generally within 2 years, can cut that to 10%. Speed genuinely matters if a withdrawal gets missed. There's a broader thing to watch as well, beyond your own accounts. This is an area of the law Washington keeps touching. The required withdrawal age has already moved more than once in recent years, from 70.5 to 72 to 73, with the move to 75 still ahead for younger savers. The penalty has been cut. The rules around Roth accounts inside workplace plans were changed. This is not settled ground, and it is reasonable to expect more adjustments in the years to come as Congress continues to rework retirement rules. That is one more reason to check the current rules against your own situation each year, rather than relying on what was true when you first retired, because the number that governs your withdrawal this year may not be the number that governed it 2 years ago. Keep an eye, too, on the interaction between these withdrawals and the other retirement changes taking effect around the same time. Contribution limits, standard deductions, and the newer senior deductions all shift year to year, and they all touch the same tax return where your stacked withdrawals will land. A change that helps you in one place, like a larger deduction, can partly cushion a stacked year, while a threshold that fails to keep pace with inflation can quietly pull more people into the higher surcharge tiers over time. The pieces do not move in isolation. They all meet on one form once a year, and the total is what decides your bill. The single most useful thing you can do with this video is simple. If you or someone in your family turned 73 last year, find out today whether that first withdrawal was taken or delayed. And if it was delayed, run the two withdrawal numbers before the year closes rather than discovering them on next spring's tax return. That one conversation, held in the summer instead of the following April, is where the real money is saved. This video is for informational purposes only and does not constitute financial, legal, or tax advice. Laws and policies change. Always consult a qualified professional before making any financial decisions.